I'm John Byrne with AML Right Source, and I'm very pleased today to have Lisa Arquette. Lisa is recently retired, former Deputy Director of Op Risk, among other things, at the FDIC. Lisa and I go way back. We've done 1 billion panels at conferences, and obviously, not only do we all respect all the work that Lisa has done, but we really want to pick her brain a little bit today because there's so much both going on, but there's so much to consider in the AML CFT sanction space, which, by the way, Lisa's done a lot more than that, but we'll talk a little bit about that. But also, I'm really interested, Lisa, in some your career paths and some of the other items outside of AML that you worked on. So, long-winded way of saying thank you so much for doing this today. I really appreciate it.
Thanks, John, and thank you for inviting me to do this. I'm excited about just having a casual conversation with you about where we've been and where we think we're going to go.
Let's start with what drew you to the FDIC. I know you started as a bank examiner, obviously a few decades ago. And the reason I mentioned that, because, back then, I think being a bank examiner was I don't say it was super unique, but it was a space that, if you were in there, you obviously had a lot of interest in financial services and oversight and auditing. So what first drew you there? And then I want to walk through some of the changes over time that you've experienced and the different roles you've had at the FDIC.
Great. Well, John, as I was wrapping up my Master of Business Administration program and interviewing for jobs, I was in Texas. And at that time, it was close to the tail end of an oil crisis. The primary places for employment were oil and gas companies, all of them, the big ones in Houston. And they were stressed, and I was interviewing with them. But at the same time, bank failures were occurring, it seemed like daily. And I became very familiar very quickly with the role of the FDIC. Of course, I knew that it insured deposits, but the mission that the FDIC has and had to maintain stability and public confidence in the nation's financial system really resonated with somebody living in Texas during an oil crisis. And so I focused on the FDIC. They insure deposits. They examine and supervise institutions for safety and soundness and consumer protection, and at the time, managed receiverships. It's grown since then. There's a little bit more that the FDIC does, but I was very interested. So I interviewed for a position, and I got that position along with many other people at the time. And it was a fascinating job. I was happy to be part of that mission, and I was for many decades. And I've seen the FDIC really address stability and confidence in the financial system over and over and over. And recently, it was in the spring of 2023 that we saw the FDIC really step up and address some significant, unprecedented issues. So it was a great job.
So when you were doing bank exams at that point, what were the size of the institutions? You categorize them as community banks, mid-size, big, or were you working on all three?
Probably, I would say community banks and mid-size is what I started working on. And I started in the Dallas region, of course, where we had failures all the time. So I only worked in institutions that were problem banks or failing banks. So I saw how things went very poorly, very quickly, and the dissipation of capital. So I was very focused on safety and soundness for the first part of my career, and saw a lot of institutions that failed. When things improved in the Dallas region, I helped out in regions where there were economic stresses in real estate. So I helped out in New York and in Boston based on my experience. Then I moved to the Washington office in capital markets. And then importantly, and still in safety and soundness, I worked with a group that dealt with enforcement actions, so really kind of addressing and cleaning up very broad safety and soundness issues, applications for deposit insurance and mergers, and problem banks. So my foundation is in safety and soundness, and I think it's pretty deep, and it stays with me.
Let me ask you about problem banks. So back then versus now, what were the main contributing factors? Obviously, some of it was economics, obviously real estate, like you mentioned. But in terms of the structure of these banks, the governance, the board oversight. Did you see, has there been an improvement over time? I mean, obviously it's been called out a lot more than perhaps it was early on, but what was your take early on with a problem bank versus, let's say, a couple of years ago, if when you were involved in oversight of an institution that had also had problems, but had them, 20, 25 years later? Over time, what did you what did you see? And we're going to go back and talk about the financial crisis in a few minutes. So I want to hear your take about that, because I'm particularly interested in how you handled that part of it. But I am very curious about how bankers were back then, because I was at the Bankers Association, and a lot of what we tried to do back then was training, right? And it was things that, forget about AML for now, just general bank training. And there was Stonier, which I know you were part of,
Right.
and we had compliance schools and all that sort of thing. But I'm very curious about how the banks were run then versus now, given that I know there were other factors that led to the problem areas, or the banks going under. So what's your take on that?
Yeah, great question. Things have changed since the time that I started with the FDIC until right now, 2025. Banks were smaller. There were thousands and thousands of additional unit banks, which means they had a small bank, maybe a parent company, very few affiliates, if any. And it was much easier to have a structure to understand and manage all risks within the institution. And a community bank meant that you knew everybody in the community to whom you were providing banking services. That's really how many banks operated at the time. So it was easier to understand risk. Moving ahead, not only to the great financial crisis, but even to the pandemic, things have changed dramatically. And over the last 20 years, just looking at statistics, there have been close to 4,000 mergers. So there's been a tremendous consolidation in the industry, and it continues. It's not anomalous, but it continues, which means that what used to be a lot, thousands of smaller institutions, they're growing, they're bigger. You've got more regionals, you've got very large institutions that operate internationally. And so the risk profile of these institutions has absolutely changed. And during the pandemic, what changed for all of us was no on-site presence anywhere. So even the growth within institutions, it wasn't only impacted by shrinking communities, it was impacted by the way people were doing business. All of us became maybe close to experts at doing online banking, online ordering, having everything delivered. And so banking changed. And it hasn't really, that was good. Some of the changes were good, but it's changed permanently, and the risks have changed permanently. And institutions are now much more complex. So what used to be a small community bank serving people within a very small geography, those banks can operate internationally with very little effort. So what I saw, and I did review every single report of examination that we sent to FinCEN pursuant to an information sharing MOU, what I saw was a real shift in some of the challenges faced by bankers, including in the area, the anti-money laundering area and in the fraud area, because they were faced with just different issues entirely, not seeing people face to face, and not only verifying them initially and developing a customer risk profile, but even validating them when they come in to do online banking. So things have really shifted, and the job of an AML department and a fraud department has really, really increased in my perspective, and the cybersecurity group, just knowing that people who are logging in and moving funds are in fact those people. It's a tough job.
And it's going to be even tougher, I imagine, when banks continue to get more involved in cryptocurrency. So I think that'll continue to test us. I do want to dive into the AML world, but right before I do that, go back to the financial crisis in 2008 and 9. I was actually at a bank at the time, so I saw firsthand. We had daily meetings with the regulators about funding and other issues. What were sort of the challenges that, besides the obvious, that you saw during that time, and what were your biggest takeaways after it? I don't say it ended, but after things got not necessarily back to normal, but obviously things got got improved. So what were you working on high level? That's all I'm interested in at the time. And then what were your takeaways from the crisis?
Well, John, maybe because of my safety and soundness background, because I was already in the Bank Secrecy Act, anti-money laundering, and sanctions space, but I had a very short notice, and I do mean less than an hour, that I was picking up all of the applications, work for deposit insurance and mergers. And the reason being was a keen focus to those who could acquire failing banks, because as you remember, most of the banks were really dealing with their own internal issues. The great financial crisis was based very largely on assets like commercial real estate, kind of retail strips, and it was not good at all. That's why it's called the Great Financial Crisis. So working with these private capital groups, I did work with the general counsel on developing standards for private capital groups to acquire failing banks based on two significant failures that impacted the Deposit Insurance Fund. And these acquiring groups had very generous loss share agreements. So that trajectory wasn't going to work out very well. Big failures and good loss share. That means the FDIC absorbed more of the loss going forward, and the acquiring group was doing okay. And most of the transactions involved private capital, not banks acquiring banks for that period of time. So I had an excellent team that worked through all of these deposit insurance applications, and we were dealing with private capital groups that weren't accustomed to regulations, like the banking industry is one of the most regulated industries, but they really did save the Deposit Insurance Fund a lot. Now, some of the issues I think that everybody saw was the very compressed time frame to acquire a failing bank. It's fast when a bank is failing. And so the amount of time to do due diligence on an entire institution is compressed. And what you've got at the end of the transaction, you've got a resultant bank, a new executive team, and you've got huge integration issues when you're trying to pull in people and systems and different parts of the institution, maybe a couple of institutions. So I think the integration was very challenging with a lot of these institutions. The systems speaking to each other may be completely incompatible. Staffs from across a large organization sorting through what they acquired. Who are the customers? Does this line up with the business model that we had envisioned? How do you manage the risk? What is the risk? What is the risk? How do you mitigate the risk? So just pulling together people, systems, locations, customer types, and recognizing that if the business strategies have changed, and they had to because the bank failed, and if the business model is different, are there customers or customer types that this group is not skilled to manage? Are the systems not set up for what this team wants to manage? And do they need to get rid of some of the branch network? So we saw a lot of kind of shedding or moving of customer types and parts of the organization to be more streamlined and healthier organization. Those were huge challenges, and it may have seemed, and again, they saved the Deposit Insurance Fund a lot. But with all integration plans and all changes like this, huge changes, the amount of time that it takes to really get the institution healthy and operating well is usually longer than anticipated. What I found to be a best practice is including all stakeholders, including the group like the Bank Secrecy Act compliance function, the fraud function, and making sure everybody had a seat at the table to analyze all of the risks, not just some of the risks, to make sure that big decisions were well informed. So the great financial crisis, I'm glad we were all working together because we made it through, and hope we never see anything like that again, but we made it through. But it was much different. And I would add that even in the spring of 2023, the shift that we saw in how banking is conducted and how people communicate so quickly also demonstrated that a bank failure can happen more quickly than it happened previously. It can happen within a day. So being prepared for the change and how we're all communicating, how the platforms are set up, is really a 2025 issue. So my hope is that we're all working together to be more effective, more innovative, and figure out what's the most important thing to do in this space to make sure that national security is protected. Each bank is protected. The U.S. financial system is protected. The global financial system is protected. These are huge challenges. And I think that the banking industry seems ready to step up and deal with them in a different way.
Well, I hope you're right. I think I worry a bit given this particular administration's call for deregulation. I think, as you know, because we've been part of a lot of debates on panels for years, nobody believes that the entire AML infrastructure is perfect because it was added over time, and obviously you have the federal banking agencies, you have law enforcement. So I mean, there's a lot of moving parts. So to your point, stakeholders. I worry a bit that again, this rush to deregulate, which sounds great, and even some of the trade associations and some of my former associations are, trumpeting that as something that is needed. If it's done, again, to your point, too quickly, I don't know that we're going to feel the response right away, but I think there's a shot there. So what I want to talk about now, sort of obviously post 9/11, post Patriot Act, post the FFIC manual, like in the past decade, there's obviously been there's been enforcement actions that we learned from those. I don't want to sort of rehash that because I think it's pretty easily understood to people. When you look at an enforcement action, even if it's not directed at your size institution, the themes are relevant, right? Whether it's governance issues, SAR reporting problems, or what have you. But at the beginning of this administration, there's been a couple of things that have occurred that I'm really curious of your take on high level. And one is obviously the Corporate Transparency Act, which took, I don't know, 8 or 9 years to get it acted. It was a long time. And as we both know, it was in part a response to FATF giving us a poor evaluation back in, I think, 2006 because of the importance of beneficial ownership. And so CTA gets passed. Obviously, it's taken FinCEN a while to put everything together. But the bottom line is, when this administration began, almost in the first month, I could be off by a few weeks, they announced that they were no longer going to have domestic entities covered under the CTA. Then I'm hearing rumors that by the time this airs in early September, that there may be an attempt to actually repeal the entire CTA. But I'm interested in your thoughts because law enforcement believes in the value of beneficial ownership information. We can talk about should there be a registry, who should have access, and all those are legitimate points of debate. But if you're not going to include domestic entities from a now former regulator's perspective, what do you see are going to be the potential challenges for both law enforcement and regulators to determine if banks actually know who they're doing business with?
Oh, that's loaded. So I agree with you. One, I think law enforcement should trumpet their needs, right?
Yep.
Should amplify their needs. I've not been in a space where I hear them do that effectively. I've heard great presentations, but I think they need to say, this is why we need certain information.
Good
but
point.
I am still hopeful because, again, going back to the data that my former agency provided to FinCEN over 20 years,
Right.
Out of all of the banks that the FDIC examined every year, somewhere around 1% or less resulted in a formal enforcement action. And in the end, those were serious enforcement actions, but that meant that the other institutions were doing an adequate job. That meant that even if there was an informal action that was not public or deficiencies noted in the report of examination, all confidential supervisory information, that they had an adequate program and generally remediated any issues within one exam cycle, maybe two. So for me, that means bankers really care about this space and will deal with their issues almost always. So the 1% matters. And it also matters that they've developed processes, right, for customer due diligence to collect beneficial ownership information and on a risk basis verify the identity of the beneficial owner, which is still intact today.
That's right.
So they've already built these systems out. And I really think that that instills a lot of discipline. You build something out and you do it. Staff does it. It's routine. And who doesn't want to know who they're dealing with?
Yep. Yeah,
I
I
think
think that
we're
makes
better
sense.
for knowing. Yeah, I
Yeah.
think we're better for knowing who they're dealing with. And everybody knows that a beneficial owner isn't just somebody who owns a certain percentage. It is also somebody making decisions. And even getting back to the standards that were developed to deal with private capital investors, the threshold that was used at the time was much lower about a significant investment and decision making. It was a 5% threshold to try to capture as much as possible, recognizing that that really mattered. Who is going to own this entity? So honestly, banks have developed processes, and I hope they're working well, and I hope they continue to make sure that they understand the risk profile of all of their customer accounts, so that they're comfortable that they're protecting their institutions, regardless of any changes that might occur.
I don't disagree that the CDD rule is still intact. The question is, will it be on the potential chopping block? So we'll see. But you're right. They spend all this money putting these systems in. They do want to know who they're doing business with. So from a risk decision perspective, it would be foolish to eliminate those processes. So, I don't know if I'm as optimistic as you are, because who knows, but I think that's a very, very fair, valid point that those systems already exist. That leads me to a couple of other questions regarding what's going on now. We had the priorities back in November of 21. They're still out there. There's no program rule yet, and there may not be one, which would have done a good deal of work to deal with the issue of effectiveness, which I think it sounds subjective, but I think everybody believes that your system should be effective, right? But I'm curious about two things. One is your take on elimination of reputation as a factor that all the agencies were basically told to eliminate from their oversight. That's the first. I'll just leave it at that. I have a follow-up on that. But what's your take on that? Maybe briefly describe how reputation factored in the past, again, high level, and then what you think this could mean, if anything, by taking that out of all the policy oversight documents and guidance and all that stuff.
Again, having reviewed every report sent to FinCEN and every enforcement action, it wasn't a frequent practice that in the AML space, examiners were using reputation. There are so many rules right now that were a focus, right? Customer due diligence, internal control framework to manage the risk, suspicious activity monitoring. That wasn't necessary. Did the bank have an understanding of the risk of its customers? Did it have a control framework in place to mitigate the risk? Banks are in the business of making a profit and absorbing the risk or onboarding risk, but they also then manage it. So in this space, reputational risk was not used frequently at all. And even in the FFIEC manual, which is the common manual for examiners of all of the banking agencies, including the states, you might find it a few times. There are other areas where reputational risk really is going to have to be cleaned up. And those areas are where there aren't real specific regulations related to a lot of activities in the institution. I will leave it there, but there are other areas that have a lot to do.
You and I worked with a bunch of other folks for years on the issue of financial access for humanitarian groups. I mean, a lot of organizations have access challenges, but the focus back in, I think it was 2017 or 2018, I can't remember exactly when we all got together at the World Bank for a couple of days meeting, we all decided that even though there are other entities that have challenges, this was an area where we could do some good. And obviously all of us, regulators, law enforcement, policymakers, worked pretty tirelessly to try to come up with, if not solutions, some better direction. And while people were not 100% happy with the outcomes, because they're still dealing with it, I think if you're going to be objective, I wasn't happy with the speed, but I was very pleased that you folks were able to come out with, and I understand why, by the way, guidance documents that were very specific in terms of saying not all charities are the same. You got to make
Right.
risk decisions, and also some of it was also on the financial sector to better explain to charities what they needed in terms of risk decisioning. And I think more of that's happening than used to. So I do think that's still an issue. I'm actually going to be interviewing some folks from podcasts from the charity world next couple of weeks to see how they think things are going. And again, nothing's perfect. I think things are better, and I want to give you guys a lot of credit because I know from talking to you and others, it's not that easy to get all agencies together on a document or a guidance statement. So I know that. What's your take in 2025 where we are on that issue, specifically humanitarian groups and their need to continue get financial access for medical and other supply? Are we at least improved over 2017? What's your take as somebody who obviously hears from banks and hears from policymakers and advocacy groups about this very important issue?
I think you're right, John, and maybe it did take a long time because, as you mentioned, 2017, I did look up the statement, and that was published in, I think, November of 2020.
Right.
Anyhow, we did meet with a lot of the groups, and I met with some of the groups, the NPOs, nonprofit organizations, non-government organizations, personally, not just the banks. And I think that there were and are a lot of things that can continue to be done. Not only was it important for banks to describe what they needed to understand the risk associated with the NGO, NPO, but it was also important for that charity to provide the information.
Right.
I think there was a common misunderstanding that by being licensed to serve a certain function, that meant that they were supervised. But you and I know
Right.
that that's not supervision.
Yeah.
Being licensed to do something means you provided some statements, but nobody's ever taken a look under the hood.
Right.
A lot of financial institutions were fully capable of having those accounts and managing the risk by having staff in different parts, different geographies, maybe where that humanitarian aid was being provided. But many other banks, smaller banks, were engaged in providing services, but really didn't understand the risks, even in nearby jurisdictions. So there was really a mismatch in where they were finding accounts. And periodically, if there was a discussion between a regulator and a bank and then the NGO, things kind of went sideways and they started looking for new account relationships. But again, I was even at a hearing that involved the State Department. There are different stakeholders that have never been engaged in helping to make sure that humanitarian aid gets to the intended parties. And some of the NGOs that I met with did share some of the risks, the real risks that are probably outside of the scope of this podcast that they faced in trying to deliver the goods or the funding, and how they even got funding to certain individuals. Not all banks are equipped to deal with those risks.
Right.
So we did issue that statement. We issued a statement on, domestic PEPs, which there is no such thing as a domestic PEP. And then generally on customer due diligence, again, just reinforcing the risk-based approach to understanding the customers that each bank chooses to onboard. Is it better? I do think that it's better, and I really think it's because of outreach like that and communications and everybody working toward a common goal and making sure that NGOs, for instance, get an account with an institution that can supervise and manage that relationship.
No, that makes sense. There are no legal terms for domestic PEPs, but some of us believe that there clearly are exposed persons in local office. I have two more for you, and again, super appreciate doing this. We probably should do a couple of episodes, so we should think about that. Yes, but so two things. The other one is the executive order that just came out in the past week. I'm paraphrasing something along the lines of fair banking or fair banking access. I'm not going to prejudice your answer, but I'm really curious as a regulator when you see this, and obviously I think everybody that listens to this knows that we've talked about this in our podcast, but basically the premise is that certain groups like gun dealers and cryptocurrency firms are being discriminated against, and even being called Operation Choke Point 2.0, which I think is a little hyperbolic if you ask me. But the bottom line is not even any of that. Even if we have a question about the premise, how is this going to work from a practical standpoint? And I'll phrase it this way. I know that Florida and I think one other state have passed laws in the past year or two that have said if a bank refuses to onboard an entity and that entity believes it's been discriminated against, it can bring an action to the State Department of Financial Services. Hasn't happened yet, but banks in those states have to sort of navigate that. This sort of leads you to, it doesn't say that specifically, but it does lead you to the same potential direction that if a bank makes a decision either to exit a relationship or to not onboard, and the entity believes that it's been done for political, religious, or other reasons and not risk reasons, that there's going to be ramifications. I've worked in the banking industry my whole life. I think that's going to be really hard for banks to navigate now that you're not sitting at the FDIC. When you saw this, from, again, high level, what were your initial thoughts?
I had to think about it for a while because to me, it looked like initially that it was this notion, de-risking, which we kind of talked about just a moment ago with charities, that it was just the same thing with a different label. But in fact, it seems to be a little bit different, and it seems to be tied primarily to religious or political reasons. And in my view, I think most people and businesses that are operating legally should have access to banking. I think where the issue is, it depends on what they do and what a bank is equipped to handle as far as risk. If they are not equipped to handle a crypto exchanger and don't understand that business model at all, they may not be the best bank to understand and then manage the risk. So I do think it really goes to the point, what does the bank do? Mm-hmm. Is it what we used to call a community bank that is serving you and I, traditional customers, or is it a bank that is very specialized and has staff that understands business models of unique businesses, emerging businesses, crypto companies? I think it's really important to be able to manage whatever risk a bank chooses to onboard. If they can't do it,
right,
makes sense that they would focus on what their business model is, and others who can handle the risk focus on those relationships. I hope it's as simple as that. It should be.
Right. We'll see. I remember the Humanitarian folks asked a very logical question at the beginning. They said, when you exit one of our company or one of our entities, we simply get a letter that says it doesn't fit our business model. And so when they said that, we said, well, you understand why that happens. In part, if the bank thought you had engaged in suspicious activity, they can't tell you. So I do think there's going to be some questions about, so you're going to need guidance in that space, I would think, from a practical standpoint. I guess we'll see what happens. That's why I say I may have to get you back here before the end of the year and talk some more. Let me get you out of here on this, and so appreciate this. I should ask you, you're obviously not done working in a variety of spaces. I assume you're trying to figure out next steps. Somebody as talented as you got so much to offer folks. So I think it would be, hopefully you're not going to retire, that you're going to continue to do things. People should connect with you on LinkedIn. That's always a good place for folks to reach out. I teach a class at George Mason, a graduate class, every summer on money laundering, terrorism, and corruption. And I bring in experts to talk to the class, both about the subject, but also about career path opportunities. And in the past, I've been able to say, you could go to an advisory firm, you can go to a financial institution, a fintech, so a non-traditional financial institution, or now you can obviously go to a crypto company that needs AML help, or you can go to the federal or state agencies, law enforcement, or banking agencies. I had to curb that back a little. Obviously, we've seen the cuts in the agencies and the pausing of hiring and all that. I know the FDIC paused hiring a bunch of examiners. So I'm not sure. I guess have hired some people back. So maybe things will turn back a bit. But if somebody in graduate school says, hey, Lisa, I'm looking for some direction. I like AML sanctions, CFT, financial crime, fraud, all that kind of stuff. Where are some places I can go from a career path opportunity? What would you tell them?
Well, I wouldn't discourage somebody from going to a federal banking agency. I got to tell you, John, I think the training is phenomenal, right? Especially if you're going to be a safety and soundness examiner. You learn how a bank operates in all areas: lending, investments, onboarding of customers, fraud, information technology, cybersecurity. It is a wonderful education, and it's helpful to work in institutions of a variety of sizes and different locations. So I would encourage that. I mean, I've been through more than one instance where banking agencies were shrinking, shifting resources to different locations, and in fact, that's why I posted for a job in the Washington office. Right, as the economy improved when I was in Colorado, it was time to look for a different opportunity and a different way to support the FDIC. So I wouldn't discourage it. I think it's really good experience that you can't get anywhere else. You can't get the experience, balance sheet accounting, access. I mean, just different types of analysis. It's not just auditing. It's better. But so I wouldn't discourage it, and things will change. The hiring freeze will end. So I wouldn't discourage it. I also think there's a tremendous amount of value in the industry itself, in the banking industry, and with money transmitters. So, depending on the person's interests, I would fully describe what my experience was, because it was good.
Oh, that's great. Yeah, go ahead, Byrne. Sorry.
Yeah, and again, there may be a hiring freeze that was extended now. It's not permanent.
Right.
Examiners are needed, and so are people in banks and with money transmitters and in the casino industry. But it's exciting out there, and this is not an easy type of risk to identify, to measure, to monitor, to manage. I think it's more exciting than people on the outside, before they get involved, really understand. It's not easy. It's not financial metrics that you can just take a look at and say, here's the problem. You really have to look at a lot of different aspects: quantitative, qualitative, behaviors. Yeah, I would encourage it.
Lisa Arquette, thank you so much. Thank you for your serving of the industry and the community. I've had the pleasure of working with you for many years, and you always kept me on my toes. I always appreciated your comments. In fact, a couple of comments you made today, you've made before. You said less than 1% were enforcement actions. So that and you would say this in public, you would say this in front of 1,000 people. That means that for the most part, institutions are doing the right thing. And you've said to something else that resonated with me: law enforcement needs to be a little more vocal about the value proposition of information, or the reduction of information. So I think that's important, because that partnership that you folks have with law enforcement is essential to making all this work. So I appreciate all of that. Thank you so much for your time today. Good luck again. I'm sure we'll see you down the line, but I appreciate your time today.
Thank you, John. Have a good afternoon.